Welcome to Deal Playbook, the show where we decode the real strategies of leverage behind scaling, acquiring, and exiting. I'm Tom Shipley, and after building and selling 16 companies, generating over $2 billion in sales, raising hundreds of millions in capital, and leading through chaos and opportunity, I've learned one thing. Success doesn't come from playing harder, it comes from playing smarter. Every episode, we will break down tactical frameworks, investor insights, and mindset shifts that move you from deal hunter to deal architect. This is your insider's guide to creating exponential growth and wealth through leverage, capital, and connection. Welcome to Deal Playbook. Let's get to work.
I think if you don't have high-level strategic consultative type practice, I think if you're based on a lot of, junior sweat equity, like that's the stuff that is more risky. And I think the lack of complexity. We've seen it, we've seen bifurcation even we manage some really large global programs. Like for them to try to replace 6 countries and find those languages in 3 platforms versus like a single program in one region that has 5 really big partners, right? That's going to be a lot more at risk. So I almost think the biggest risk is not innovating. I don't think anyone can afford to sit still right now.
I can't tell you how excited I am to have Bob Glazer with us today. Bob Glazer is just a well-known legend in the agency world with the platform that he built with Acceleration Partners, the books, his focus on cultures and the way he built a successful agency, and the way Acceleration Partners became a platform. So excited to have you here, Bob. Excited to hear the feedback. We're going to have some good discussion today. But to kick it off, I would love for you to share a little bit about yourself.
Sure. I've started a few different businesses in my time, the largest of which is Acceleration Partners, which became a 300-person global partnership marketing firm that does a lot of affiliate and increasingly more influencer marketing. We built sort of a platform that was an agency that was detached from some of the platforms and affiliate that people were both using as their technology and as their agency, and felt like people really should have services separate from technology. And as the SaaS players came about in affiliate, we kind of built a business around that. So yeah, we had a culture that was a little unique. We were always fully remote since our beginning, something that we kind of tried to hide before COVID. And then we lost a little bit of our competitive differentiation. Now it's back because I say all the sort of pretend work from home people have now given up. But yeah, so that was a 15-year kind of journey to build that firm. And we did a partnership with Mountain Gate Capital at the end of 2020 and are still working with them and have done 4 acquisitions as part of that platform.
So give me an idea on, kind of some milestones on 0 to year 5, how big were you in 10 at 10 years, just so understand from a growth perspective what that looked like.
Yeah, we were doing about 20 to 30% consistently for almost a decade. So it took a couple years to hit $1 million from, I guess that was like around 2007 or somewhere around there. And we were just kind of growing steadily and consistently, mostly all organically, no acquisitions up and sort of through COVID. And the beginning of COVID was a little rough, and then things accelerated as people wanted to do more performance marketing and more e-commerce, and actually were trying to move away from things that were further away from the transaction.
So it was after the transaction you did your first acquisition, or before you did the deal with Mountain?
Yeah, we did it almost right at the same time. So we had been talking to one of our competitors. They had been talking to another one of our competitors. We knew we did our deal. We had sort of been flirting for a long time. And I think it was within 60 days of our deal closing, we closed on that first deal.
That's amazing. How big was that relative to your business?
We were probably 2 something, and they were about 35 people. So that's kind of a good ratio. I think things get messier, the more you have. Someone once told me you want to be bought by someone 5 times bigger and buy someone that's like sort of a fifth of the size, right? I think then you don't get into this. It was clear we were the platform, and while I always say like it's going to be our culture, hopefully you want to work with us because it's the culture that you align with, but we're not going to start redoing the core values and rethinking, our fundamental approach to business. Obviously, people have ideas and things that come in. I think these firms get in trouble when you do these like 200 and sometimes, and we're not sure who's going to lead it and which culture it's going to be. And so we really wanted to avoid that. And I think, in a platform structure, it's kind of clear, like which companies are the platform and then which ones are rolling in. So we've looked at each of those individually in terms of the brands and what's basically best for the customer. And because we want to be selling the customer different products and services, we've ultimately brought it all under the same brand.
What was your revenue when you actually did the deal with Mountain Gate?
It's probably about 40 million in revenue, I think. I'm thinking back.
So let me ask you this: is there, thinking back, now that you know everything you know about acquisitions, would you? You did have a very strong, consistent growth over the years. Would you have done an acquisition earlier before Mountain Gate?
I don't know. I don't know that I would have known how to do it. I think at some point everything we were doing was for the first time. And there's both, dealing with the financing of it and the work on it and the due diligence. I mean, one thing I really come to appreciate about private equity is sort of how they do diligence deals and look at deals and customer cohorts and just know a lot of questions to ask. I mean, I looked at someone sent me a sim from, I didn't realize it, but it was 2 years ago, and it's business and it just looked amazing. And it's like completely collapsed since then. And so I'm sure if I had some young smart kid had gone through that, they would have pointed out this massive customer concentration that was missing, or that they were just feeding in the top line faster than the bottom line was falling out. There's not a lot of, I think at bigger scale, if you haven't done that, if you're acqui-hiring a 3-person firm, that's different than doing that. I generally think doing something the first time, you're usually going to make a lot of mistakes if you haven't done it before.
And then for context for people listening, at our last DealCon in February, Bob was one of our keynote speaker. Was the keynote speaker.
I heard phenomenal. The best is what I heard.
It was the best, 100%. Yeah. And basically the presentation.
That's what my feedback card said. So yeah.
Someone said, Tom, give it up and don't ever have another event without Bob Glazer there. So the topic that you focused a lot on was valuation, which was extremely insightful, of talking about realistic, unrealistic discount factors, but came in at a very interesting angle. And also the rule of 40, which was also really interesting approach on that. So I'd like to get into that a little bit, but take me back to the day when you realized that it was time to actually do a deal with Mountain Gate. What was happening in the business, in your life, and what pushed it from maybe one day to it's time now?
So it was definitely COVID for a couple of different things. And we had been having some conversations kind of going into that, and I had been warming up to the idea. And look, all of that growth, 10 years of growth and 30%, it just was all constant reinvestment. And whatever the P&L said, it wasn't what my bank account said. I think particularly if you're growing 30% a year, you start signing these great enterprise clients, right? And they like to pay after 90 days, and your employees shockingly like to get paid, in the current month. And so the faster you grow, even the more cash is consumed. And at some point, I had $1 million equity line on my house that was or in the business, but personally guaranteed, sort of my house on the line. And that was a year of payroll. And then we ended up going into COVID, and there was sort of 2 months of payroll. And so I was kind of looking at this being like, look, I've built this house that I almost can't afford to live in. It's like if your rich uncle gave you a $10 million house, and then the furnace breaks and the roof things. And I had COVID was really scary. It was like, again, am I going to deplete this or use this money? And so coming out of that, I was like, you know what, it's time to like harvest, and sort of, recoup this. And I felt like the team wanted to keep growing, but I the sort of the notion of doubling down, and like, wow, so we double down again. And then there's a business I really can't afford to fund. So I just felt like I also had written a document years before that ever said like, this is what the perfect partnership would look like. And, I consult other people on this. And sometimes when you say that this is what great looks like, and then someone offers you something close to that, don't move the needle. And so when we kind of find the right partner and the right kind of deal that would let me continue to be involved in the business and do what I wanted to do and elevate my number two, I sort of, this feels good. We can continue to grow and we can do these things, but it's not all on me. And people aren't looking to me and saying, well, how much do you want to invest in the business this year? So, at some point you're growing a business like that and you've tied 99% of your wealth into a liquid asset.
What people don't understand when they hear of exit, they think that they're exiting the business, which is very seldom the case.
Yeah.
What are your thoughts as far as strategic options for sellers?
Yeah,
or for
certainly
business
not.
owners?
Certainly not in services, right? In services, people are looking at the team and the capability, and it's only good as the people. So they're buying that asset. It's not like bad old analogy. You make VCRs, we make TVs. We're going to buy your VCR business. We don't care about the people. We're going to combine the products together. So you have to give a lot of thought in a service business what comes after day one. At those size, I had heard a lot of agency stories that were kind of nightmares, and also, the earnouts. And back at that point, like private equity was just offering a much more compelling path than I think strategics were. And the overwhelming number of agencies were partnering with private equity firms. Now, eventually they'll be big enough and have to, go to a strategic buyer, and I'm probably not going to go public. But the notion of these 5-year earnouts and being miserable and not being in charge of your business versus kind of like it's business as usual. That's the trade-off. If you're the platform, it's your culture, it's your leadership team. Mm-hmm. You get to do all the work. You don't get any more money for it. And if you roll in, you can hang around for 6 months and probably keep your equity and do something else if you wanted to do it. So the trade-off of being the platform is a lot of extra work and responsibility. The upside is it's your team, it's your culture, it's your brand. If you looked at our business almost 5 years later, it doesn't really look that different from who's doing what on the outside. Mountain Gate is not an operating partner.
At that point, when you sold, was Acceleration Partners, was it professionalized? Everything from accounting and finance to structure where it was really in a good position to sell?
Yeah, we had I think we had really good leaders in each thing, and we had sort of done reviewed financials, not audited financials, but we had GAAP accounting, we had professional sales team. I think I really tried to, as I said in my speech, take advice from people who had been on that road ahead of me, and I think a lot of people don't do that, and they said, look, this is what people value. This is what they look for. This is what you want to do. I remember my friend David Rodinsky telling me when to do his deal, they were like, pulling receipts out of shoe boxes and stuff. So we had hired a CFO. We had done the reviewed financials, which makes audited financials a lot easier. So we had taken a fair amount of those steps, knowing that, like, look, if the opportunity presented itself, you want to be ready. I always kind of believe in optionality. And also those are just best practices systems for a company that size. And you need some people in the room, because usually the founder hasn't done it before. So you need to start bringing in those people who've done that thing that you want to do.
So I'm talking to a lot of owners of businesses, and especially more owners of agencies. And the one question they're looking at is their EBITDA, where they're at, and realistically from multiple range, would that hit their number that they can actually say that's a comfortable number for them? So they're vacillating back and forth, but then they're kind of like a deer in the headlights when it's coming to AI, what that means for their business and what it means also from a prospect of a sale of waiting a year or two. So if a founder is listening right now and sitting on the fence, what are the two questions they would need to answer for themselves before they should think about pursuing a sale?
I think you want to know what your number is and what's actually enough. And by the way, when you don't get that sometimes, you realize it's actually a lot lower, right? So that's why I think you need to really feel like, what if the other option was zero, what would enough be? And then where is the market? The market is not where it is 6 months ago. It's not where it is 3 or 4 years ago. I know some folks that were just kept on waiting 4 years ago. They wouldn't get a better offer today, right? If you look at the data, like timing and markets have more to do with outcomes than how the business is doing, right? There are moments where assets start moving and consolidation. So I would look at sort of what is the strength, what is the weakness, and where is the market, and how does that relate to reality for what good looks like for you? Because as I was saying, I talked to someone recently who I think their expectations are well above where the market is. So they're going to spend a lot of time on that, and it's really hard to move yourself down. So let's just say for simple numbers, right? They think they've been told it's 10 and the market number is really 5. If they go in thinking the 10's they probably will self-sabotage at a 5 offer, but a 5 is probably totally fair. And by the way, a 5 is a hell of a lot better than a 0. So I think it's really hard for people to get. I think it's so important to have realistic expectations and hope that the outlier is the icing. It's not the cake. I've just seen people torpedo themselves when they go into processes with expectations that are well above the standard deviation.
So true. Even I, on at least one, if not more, of my businesses, missed that window, and then it was painful. It was very painful.
It can take 5 years to get back to where you were, right? And a lot of times people have a good year. Well, it might get better. I mean, I remember saying to people 3, 4 years, like, debt is historically low. These are 20-year high valuations. Like, are the odds that it gets better or that it gets worse? and tried to buy their businesses. And I understand they might have thought that I was, full of it. But as I said, in my presentation, I keep a little black book of irrational sellers that I talk to, and I just haven't seen any of them sell. And I think their businesses are worth less. And they've probably spent 2 or 3 years playing around and going to market and flirting a little bit and coming back. And when you do that, A, you tire out your deal on the market, and B, you take your eyes off the ball of your business, and then performance declines. And I think if any of them had really had good advisors who said, this is a good offer and fair, like, they would probably take in a heartbeat some of the what we had offered them 2 or 3 years ago today, 100%. If they had the choice.
100%. So are you finding that your the deals that you're getting done is a better value for acceleration partners because of the market?
We haven't done one in a while. And in marketing services, there's sort of I think you're about to get to some breaking point of people who are tired of waiting. But it's either been a couple deals that are, the top students, the valedictorians, and they're going for prices we would never pay because they just don't make sense. Like when we look at it. And then everyone else, it's a lot of wounded birds and not going to market, or next quarter we'll check it. Like, they're just never actually going to market. And I think that it's because their numbers aren't where they want them to be. So we've had a bunch of those conversations. Next quarter. And they don't want to move because I think it's not, they know that the reality is. But that's also still probably looking at maybe even where the market was a year ago. Again, a year ago, we're doing a lot more in the influencer space. We've looked at 80 businesses in influencer at least.
Wow.
And it was much hotter a year ago than it is now. Multiples have definitely normalized, and I think retail media is the next one to normalize too, right? It's just it's super hot, and everything kind of comes down to the mean eventually. So I when my friends are, rolling up accounting firms or something like that, or distribution. You can always find someone who's old and tired and wants to throw in the towel or kneel retirement. The problem with marketing and services is people tend to be young and optimistic, and they think that next year is going to be better. I'm starting to get some sense, though, people like maybe it won't be that much better. And like, again, as these consolidations happen, and as I said in the thing, like, it was said to me once, when industries start consolidating, and they will, you can kind of be a roller, you can roll in, or oftentimes you'll get rolled. And you don't want to be on the outs. When scale starts to matter a lot, it's hard to be on the outside of that without it.
I love the expression, when consolidations happen, you can either be a roller or get rolled. And it's neither good nor bad to be either one.
You can be a roller, roll in, or get rolled, right? So those are the three options.
Yeah. Or just be left behind. How soon after you did the deal did your role change at the agency?
We had planned for it to be a year, so we've waited sort of a year. I think a lot of changes at once, and I, it actually was changing a lot. By the time we announced it, I sort of made clear to people, hey, look, I'm not even manage anyone anymore. Our president has the whole leadership team. He's been leading a lot of the calls. Like we've been doing this for almost 2 years, in the background. So the actual change really wasn't a lot by the time it happened. And I sort of went down to 3 days a week for sort of the next year or 18 months, and then kind of a day a week after that. And we all felt it was really important that I sort of cross the chasm to that board role. And even though I wanted to be in a lot of those meetings, get out of those meetings because I didn't have a role, and I could play a board and exec chair role, or I could play an active manager role, but I couldn't kind of be on both teams. And I did a lot of things wrong, but I think one of the things I did right was, as soon as we made that choice, people have been, I left the room, so there was no one looking around at, well, what does he think? And really kind of got out of the way, knowing that, I had been a big personality in the business, and I didn't want any ambiguity that, this was some sort of shadow thing versus Matt was in charge.
That's phenomenal. If you haven't done a number of acquisitions in a while,
not for lack of trying.
Are you planning? Oh, really? Really?
Yeah.
Just good deals at the right valuation that makes sense for the business?
Yeah. In the agency world, like I said, there's been a few of these kind of outlier gems, and then there's been a lot of, we'll be back next month or next year or next quarter, or we're not even listing because we've been flat for 3 years. So and anyone in, agency performance marketing is telling you that it's been a great 3 years is lying, right?
Yeah, a great consistent 3 years ago.
It's been a lot of different crises, supply shock, venture capital is down 90% or whatever it is. So that's really taken the growth capital out of a lot of these brands that normally come in and say, hey, I want to grow and I want to expand. And we have those brands, but actually it tends to be the larger companies. A lot of other brands are like, hey, how do we spend less next year? You just feel that capital drained out of the system and everyone being more cautious, because it's just been, it's been a lot of black swans over the last few years. With the latest being all the tariff madness, and clients like, do I bring in product? Do I not bring in product? Do I market? Do I not market? So insane.
Yeah. Just especially when someone says, we've seen the worst of it. What else can go wrong? What else could happen? And then the world surprises you. So let me ask you this. When you're dealing with sellers, what is the one or two stories of the worst mistakes a seller has done that when you thought you were going to get a deal, it blew up the deal?
There's been a couple, I think. So I think the worst mistake is trying to do it themselves and not realizing things like, hey, you can't say to people, if you have 3 founders making $80,000 that you all want to make $200,000 when the deal was done. Like, that lowers your EBITDA. Like, and just not understanding the rules of the game, and then feeling like, because I think if you do this enough, and Tom, you've seen this, like, I think the rules are pretty consistent, right? And I think the problem is people who think that they don't apply to them. Like, I've heard a lot of these, horror stories, and I know they exist around people who retrade and do all this stuff. But I've also seen an equal number of things where the seller left out an important material problem with their business, or they want some change, or they want a rule, or they want something that's just not standard. And if they don't have if they're using their family lawyer, or they're representing themselves, they just don't have someone telling them these things. Bankers love when I give the presentation that I gave at DealCon, because they're like, "You're doing my job. You're telling, you're telling all the tough love stuff that we have to have these conversations." I thought it'd be great to find, businesses that didn't have representation and we get a great deal. It's kind of like trying to buy a house without a broker. It actually can be really hard to get the deal done because they don't understand what proper adjustments are and how to do add backs and how someone else kind of looks at the business. So I think that is one mistake. If I think of the one type of deal, and another is like just misunderstanding the market in terms of, trailing 12 months, the multiple, or this constant like, "Oh, we're going to talk to you in June and we're ready." And you check in June. "We want to talk to you in August." You check in August. "We want to talk to you in January." Like the momentum killing on that. And again, I'm not sure what you're chasing. If you're rolling into a platform, you're actually losing getting in on the equity and the growth of the whole thing, versus you're trying to like print one good quarter and think that someone's suddenly going to value your business totally differently. And now you've lost a year of working together on getting the business together and making the offering better, which I have to think actually leads to a better outcome.
So let me ask you this, just from a deal construct, and I love creativity around deals, and I've had flexibility that I can do it. One thing, I meet a lot of sellers who have very optimistic, we're sitting here in February, March, April, they're extremely optimistic. They're not really crazy about the trolling, but they're 100% convinced what this next year is going to bring. So They said, let's just talk in Q1 of next year. So the deal construct I do typically is I like to close the deal now, pay them for their business, and do the deal struct now. And then in basically, rather than waiting a year, it's kind of like an earn up. It's a little bit different. It's like topping it off. And I said, we're going to do in Q1, you get your financials. We're going to run this as a separate division, so we have clear books on it. And we're going to do a true up at the end of Q1. So if you really do hit your numbers, you get that incremental number of seller, your seller note goes up, your incremental equity, you get some more cash. And so I've had sellers get excited about that and asked to be able to close deals where people were really convinced they were going to wait another year. Have you done anything like that?
We've done a little bit like that. I do love that approach. Typically sometimes, the bankers don't love that approach, but I love that approach because look, let's not get into this win-lose. Here's the baseline. Again, we're going to keep it separate. I put a sort of 6 month to a year. I think earnouts that get over a year get messy because it takes 6 months to integrate anyway. And we're not going to, if I'm going to run these businesses separate for 3 years, then why am I running them anyway? So we're not going to exert control. But I think that's important. I also think it's important because founders are really good at loading up the sales right before a deal gets closed. And then you find that those are really high churn deals. We experienced that as well. So I think that deal structure is totally fair. I think even 6 month earnouts or top offs, we're like, look, we're going to leave you alone. And if you crush it, you crush it. But like, why, as I said, why are we all waiting and playing this game? And, by the way, if it goes down in half, that's a problem too. So,
when you did your deal, we'll give up, how did you pick your investment banker? Were you happy with them? If you're happy with them, you more than happy to share their name.
Yeah. Again, I was all about talking to the people that had been on the road and done agency deals where I want to do agency deals and who did they like. And so Sanjay Chadha was our banker at Canaccord. And he's done a ton of stuff in the services space and it's just excellent. And was highly recommended. Same thing, got lawyer recommended. Every recommendation was someone who had done exactly what we wanted to do. And I really felt in marketing services and I had a feeling we were going to go private equity. This was the same thing on the lawyer. I wanted people that, had experience in that. And I felt like a specialist was was better than a generalist for what we want to do in terms of who the buyers were and who the knowledge was. So we had some great options, and there's some great choices out there. Yeah, that I think this is, I think you go. I try to help people on the road behind, because Dave Verdinsky did exactly what I wanted to do. He had two different bankers, and Sanjay did his last deal, and he was like, he's the man, go with him. And it became clear. But I also did extensive due diligence. Similar, I think Mountain Gate told me I was the most amount of like reference calls that had ever been made. I asked them for, what was impressive was I asked them for a whole bunch of scenarios. So I want a current portfolio company I passed, someone you turned down, someone that turned down you and went with someone else. And they gave them all to me the next day. And I called them a deal that's like not doing well. I started calling them all, and they didn't have any problem in getting that list together. So I made at least 10 or 15 reference calls.
That opens a door for, tell me your philosophy on reverse due diligence. And again, does it matter whether I'm being acquired by a larger entity or a smaller entity?
I mean, it matters on the deal. Like if you're out on day one, you might not care. If this is a 5-year partnership, you might care a lot. But there's some questions about when you do it. I think you should also back channel, you should ask around. I mean, I had a whole list of questions. Just like in interviewing, I believe in asking forced, negative questions. Like what's the most dishonest thing you think that they did? What's the time when they told you to do something you didn't agree with, right? Most people are terrible interviewers. Look, I'm even shocked. Like there are companies that we work with consistently that constantly hire our ex-employees because they know them and like them, and they never reach out for a reference check. And some of these people I would have been like, they're amazing, and the other ones I would have been like, no comment. So it's just, people are so lazy around this stuff. The best people I know do their work, do the reference checks, and also ask the people that didn't give them their name, right? It's not that hard to triangulate and figure out.
Let's pivot a little bit to something that no one's talking about, AI. So how do you do, I'd like to get your thoughts on your viewpoints on what the impact's going to, no one really knows, but to your best shot as far as the impact of AI on different agencies or agency classes, and how does that impact you buying an agency, especially when you're paying 4, 5, 6, 7 years of EBIT in the future for when you do an acquisition. So,
yeah, I look, AI is going to be a fundamental part of, I think, any agency. I think there are a lot of people believe that you could have some really cool agencies of the future that are very high margin, and have fewer amount of people that are doing the strategic work. I think what they're going to eliminate is a lot of the associate and junior and data and processing roles. First they were all going offshore, and now they'll probably go to AI. And that's also just because those roles are hard to fill. It's hard to keep people. They don't want to work more than 30 hours a week. Like some of the available employees in this market are making AI a very easy decision, right? For some of the agencies, it used to be you came, you wanted to work hard, you wanted to learn. There wasn't a lot of whining. It's very different today. So I think that, it's interesting from a consolidation play. I think we think about it like, oh, if we could get this to work and we could get this to work in AI and automate this, and have this kind of access to data, then like that acquisition looks a lot more interesting. So someone had said, and I think it's true, I think people are looking at things from two things. Either the company has started to figure out AI and is making material gains on it, or someone's doing really well and hasn't done it at all, and that is an opportunity, right?
Right, 100%.
Yeah. So I think you have two things. Where like, how do I take how do I take someone who hasn't figured out it well and bolt it on, or figure it out? But I think you have to be looking at it. I think it's the new table stakes. I also think the notion that agencies will go away, we've heard this for 30 or 40 years. A lot of these AI tools, like even just take the affiliate space, there's a whole bunch of things that like, I think they're going to look for someone to come with the tools and deliver it. I don't know that the affiliate team at that department is going to get into all kinds of development. I mean, they can't even keep people for 18 months. And you know how hard it is to get companies to build stuff and sign up with this thing and put it together. And then software companies like agencies, because the turnover rate at these companies is so high that you try to get your product in there and then someone leaves and then no one uses it and the next person doesn't know how to use it. So I tend to believe that people will come to us and say, look, we have the most data, better data. We have all this AI. We have all this stuff set up to mine our data and find you the best partners. If you want to go figure out how to put together systems to do partnership AI and all that stuff, like Godspeed, but that's a lot of work and a lot of money, without the payoff right away. So I think the agency of the future is going to look like fewer senior level, client level people with a lot of the crunching stuff being done by AI. But AI is very domain specific for the task that you want it to do. Our thing is we have millions and hundreds of thousands of partners and transactions. So how do we, my pitch is like, Tom, you can go build your program and do this by yourself, or I can start with 100,000 partners I've worked with, all the data I've mined, and figure out how to get who into your program overnight. And I have all these tools and I've been optimizing them and I come with them. Or do you want to have to go figure all this out and have 100 companies rebuild the same, thing? I think you have to pay attention to it. And I think it's either an opportunity or a threat based on how you look at it. But there still is a little more, look, everyone's talking about the agents, and there's still a little more hype than reality on some of these things. I think on the productivity efficiency side, yeah, we're seeing a lot of that, like drafting emails to clients, pulling data, replacing pivot tables. I think on the things being fully automated without humans, there's someone's got to vouch for this stuff. Like that's the one thing at the end of the day.
Is there any specific segment in the agency space that you feel is more at risk because of AI? Again, at one time people were concerned about SEO, but then there's GEO or AIEO, which makes it less risk. But is there anywhere where you say that this agency is more susceptible, or maybe it's a meta agency because Mark Zuckerberg is on a roll that makes that everything is automated? So.
Yeah, I think if you're on a single platform, if there's not a lot of complexity, if it's done by the platform, then that gets harder and harder. But you also still have to understand the reason why Facebook never had a social agency and Google never had a search agency is because it's a little bit of a conflict of interest. They're just trying to push volume on you, and the agency is trying to focus on yield. I think if you don't have high level strategic consultative type practice, I think if you're based on a lot of, junior sweat equity, that's the stuff that is more risky. And I think the lack of complexity, we've seen it, we've seen bifurcation, even we manage some really large global programs, for them to try to replace 6 countries and find those languages in 3 platforms versus a single program in one region that has 5 really big partners, right? That's going to be a lot more at risk. So I almost think the biggest risk is not innovating. I don't think anyone can afford to sit still right now.
Totally different direction on the question. You're talking to a young person who's graduating from college and basically is entering the world right now.
I'm talking to my daughter in a year. Yeah.
You're talking to your daughter. And if she, what advice would you give her?
That is, I've been consistent. It's been a rare run of 13 or 14 years, since the Great Recession. I think most of the people, Gen Z doesn't remember it, right? The millennials do, and I think it's been very much a flexible, movable, market. If you look at now, the large tech firms haven't created any net jobs in the last 3 years. Computer engineering is down. Entry level jobs are down. You can't operate in the world like you operated. I think you should go into these jobs. I think you should work really freaking hard. I think you should not complain and say you have a mental health problem because someone gave you a bad review. And I think you should learn and become indispensable. Because if you don't, there's someone that'll work better or a machine that will do that. I think the offering that has been coming in is just not going to fly, which is I want to work 30 hours and I want work-life balance and I don't really know a lot and I've got a lot of stuff going on outside of work that impacts my ability in work. Like, you just got to understand from the buyer's perspective that it's a different market now. Like, the job market is not what it was 2 or 3 years ago. The chart I just saw is just striking. I mean, the absorption of new roles by Amazon, Google, Meta, and all this stuff over years, and it's been net zero for the last 3 years. So that playbook is not a recipe for success. This is where I think schools are making a mistake. I think they should teach kids how to work with AI and come into the company being the person who shows people, oh, I can automate these reports and you don't have to do these pivot tables. Like, it's not, look at Shopify, it's part of your performance review now. So if your college thinks it's cheating and your workplace like says that if you're not using it, you're behind, that's a huge disconnect. But yeah, I that's why I tell them, like, you better go freaking work hard and learn a lot and become valuable to someone.
You're so dead on. It's about, I always say, be the obvious choice. Yeah. And in this world, the biggest thing that I see that changes is that anyone in any role, regardless of whether you're the CEO or entry level, is the world right now is about learning and adaptability, and you better be growing and hungry and curious and just trying things, especially in AI. Is you've never built an agent, go and just do it. You've never done no code programming, just spend a few hours and develop your first silly app. You don't even know what to build, use ChatGPT. Become the obvious person in your company and get knowledge and understand that everything's evolving, and therefore look at it, change the physiology from fear to excitement, because those people that are excited and passionate about growth and learning, I think, are going to win.
You should be working a lot because you're a sponge and you're in learning mode, right? Even my friends tell me that, who are training medical students, that the restrictions that don't allow them to work 100 hours a week anymore are good, but they need more years of training because they're not getting the reps on the surgery table. After their fellowship, they're kind of not there. So I'm not someone who thinks you should just work to work, but I think when you're in your 20s, you should just be like a sponge and absorbing and taking as much as you're. And if you're trying to do the minimum, there's no way you're going to do that.
No. Volunteer for everything if you can. So as we're wrapping up, is there any final advice you want to give business owners right now and agency owners?
Yeah, look, think about what you want. Give yourself optionality. Lay out what good looks like and sort of stick to that. And if you find yourself wanting to do a transaction or pursue that, talk to people that have been on the road ahead and listen to them. And I guess my biggest advice comes like, don't believe you're the unicorn. I think that is look, when we went to do a deal with an affiliate agency, there really hadn't been any market for that. That didn't make me say, oh, well, then it should be 20 times earnings because no one's ever seen this before. It looked like an SEO agency or a PPC, like that. It looked like every other marketing performance agency of a similar model. Like, I think to say we have no peer or no comparison is a silly thing to do. So find the people on the road ahead, take their advice, get them as your board members or mentors, and try to do what they did.
Perfect. Bob, thank you so much. And I really appreciate it. Appreciate the time and just enjoy being around you.
Thanks so much, Tom.
Thank you for tuning into Deal Playbook. If today's episode sparked an idea or gave you an edge, share it, subscribe, or leave a review. Remember, opportunity doesn't wait, it's created. Until next time, keep building, keep scaling, and keep playing to win.